Hi, Jasmine here from Redwood Financial, and this week's frequently asked question is how is the cost of living crisis affecting my investments and pensions? It's a really good question, and to get right to it, there's obviously no two ways about it. Inflation is affecting the real money value of our investments and pensions. It's increasing stock price market volatility, so we're seeing losses in global equities, as well as weakening consumer spending power, not just in the energy, petrol and food sectors, but overall, which is of course then having a further dampening impact on stock markets. So what have we seen since the start of the year? Inflation and then the market volatility means that in real terms, we are losing money in most of our investments. Even for those of you who are not invested in stocks and shares, perhaps you're sitting on high amounts of cash. Yes, we are starting to see bank interest rates rise, but nowhere near keeping pace with inflation and how far inflation has risen up to, over 10, 11% now. So in real terms, whether we're sat in cash or whether we're invested in the market, we're losing money right now. So investment returns are going to continue to be squeezed, even if there are some asset classes that are performing a little bit better, or we expect them to perform a little bit better between now and the end of the year. Essentially, the pressure is only going one way at the moment, and it's increasing. So what does that mean in the overall picture of your finances, though? And how do we combat the fact that we've got real assets being reduced in value, but at the same time our expenses and our cost of living is going up, and that therefore might be affecting our income? Well, what we need to do is we need to look at the whole picture. It's not just about the money that we have in the bank or our investment portfolio. What is the other assets that we have that we could use to perhaps produce more of an income to meet the rising cost of living and to help with your monthly expenditure? Are there some assets that currently are not income producing that could be changed if we change the investment strategy to start producing an income for you? Do you actually need to take your existing investments and change the strategy to better suit a high inflation environment? And looking at that whole picture coming together, it's also about understanding overall how long have you got left to live and how long do your assets need to last you for? Often what we find at Redwood is a lot of clients are sat on high cash levels or high investment portfolios that they've been saving for a rainy day. And the reality of the situation is that they're never going to run out of money. And so actually it could be that a slight tweak to the investment strategy and taking a slightly higher income at the moment to help meet that rising cost of living won't actually have a massive impact on your long-term financial position. And then once this inflationary or high inflationary environment comes back down and tempers, you can then reduce your income back down to something that's more sustainable. And it won't have probably a massive impact on your longer term strategy. Now that's if you're retired and you've got a good nest egg built up around you. Obviously, if you're still in that accumulation and building your wealth stage and you're still working, then of course that might not be the situation that you're in. So it's important to understand where you are right now, what the impact is if you do something now, and what that impact is going to be immediately, but also how it can affect you in the future. So obviously, with the fact that the crisis has no signs of abating anytime soon, although we are forecast to see inflation start to reduce in 2023 as all of the measures from central banks starts to really bite and kick in, it's fair to say that this high inflationary environment is certainly going to be with us for a long time. But despite the fact that every crisis always seems unique, whether it's the Russia-Ukraine conflict that's had a hand in driving this current high inflationary environment, it's important to remember that previous comparable market cycles have shown us that this will come to an end. Everything does. The markets run in these cycles, and they are fairly predictable in the sense of how long they tend to run on for before we move into a recovery cycle again. So it's important to understand that whilst we do have to endure the current market environment that we're in, we need to take that long-term view, take advice on how taking a bit more income to help ease the pressure with the cost of living crisis at the moment will affect your long-term financial position, and be proactive. What changes do you need to make to your strategy to accommodate this new high inflationary environment for however long it's here to stay and for however long it's with us? The worst thing you can do is kind of just stick your head in the sand and just continue to do what you've always done. You need to be proactive. You need to make sure that you're taking advice, whether that's from us or whether that's from another firm, to really understand actually what you can do to improve your current situation and how that affects that long-term goal as well together. And that's really what a good financial advisor should be doing for you. I hope that helps answer that question. But if you have any more questions on this area, you can check out our website. We have lots of blog content, but you can also have a complimentary call with us as well to get some specific advice for your needs. That's it from me for this week, and I look forward to answering more questions next week.